what did the market react to? Was it the election? Was it the virus coming back? Was it the lack of stimulus? What drove all the volatility? It didn't actually move in the end very much, but boy, it went up and down a lot.
Well, the market is definitely losing hope over one piece of the puzzle that we were expecting, which was stimulus, and that is going to cause growth to stall a bit. In addition to that, we are 5 weeks away from an election where the odds are increasing of a contested election. All of that is going to lead to a bumpy road and volatility for the rest of 2020. But fast forward into 2021, and we're fairly optimistic. Valuations are less than they were coming out of August, and also growth is actually quite positive. We have low interest rates for a number of years, and those are positive for equities. And then finally, that vaccine later this year or early next year, when that comes into place, that's going to be positive and give us the light at the end of the tunnel that we need for COVID-19. So this is a bump in the road, but going into 2021, we think that earnings growth will be positive along with economic growth, and that's good for equity markets.
Michelle, Saira says that if we don't get that stimulus, it's going to affect our growth pattern. What at Bank of America are you projecting right now? Are you projecting some more fiscal stimulus or not? And what does it do to the growth in GDP for the rest of the year?
Sure. So our baseline forecast is that we don't see another round of fiscal stimulus before the election, but we do see it after, that there's a general acceptance and understanding that there needs to be a greater safety net. It's just politically very hard to do that right now. So if we're right and there's no additional stimulus through the end of the year, we are seeing a speed bump in the economy. So we have GDP growth coming in at 3% in the fourth quarter on an annualized basis, and that follows a 27% increase in Q3. So naturally, part of the slowdown is just the fact that we no longer have as big of a bounce off the bottom. You know, that 27% increase was just the initial surge in activity when the economy reopened. But now that we're only growing at 3%, it shows that there's just some challenges. This is a difficult recovery. And there was a very deep hole to climb out of.
Well, exactly. And the way you projected, what are you looking at 2021? Because, okay, 3% is better than none, but it's going to take us a while to climb back out. 26% in the third quarter, but the second quarter was down a lot more than that. Right, Michelle?
Well, that's right. So if you think about this from a level perspective, our forecast of Q3 will have led the economy to retrace half of the decline from COVID, half of the loss of GDP, which is quite similar to what you see if you look at the labor market numbers, where about half of the jobs that were lost are back. And the unemployment rate's at 8.4%, which again is halfway back to where we were pre-COVID. So it all kind of adds up very similarly. And that's encouraging. We got halfway there, but we still have the rest of the way to go. And obviously a 3% growth rate is quite soft. We do think into next year, growth will accelerate a bit upon another round of fiscal stimulus. Perhaps we do get that vaccine. Perhaps you have a bit more of what we would call learned immunity, where people have the ability to go back out and engage and doing it safely, which allows for a bit more economic activity.
So you and Michelle both mentioned the election. Are we more worried about who gets elected, or are we more worried about whether we'll know who gets elected? We had Goldman Sachs actually this week say we shouldn't be as worried about that as some people are.
I mean, market volatility will increase if the election's contested. That'll cause probably 6 to 8 weeks of uncertainty for the markets. But then we do need to think about which sectors to own depending on who gets elected. So if it's a Democratic sweep, we want to look into more like renewable energy, maybe more stimulus, which is good for infrastructure. Investors can also think about election-proof companies. So these are companies in technology, consumer staples. We like dividend payers, which look cheap on a multi-year basis. Real estate with low rates. These types of companies, in a sense, you don't need to care who wins the election because they're going to continue to do well either way. So, we are concerned. We do think there could be weeks of volatility if the election is contested, and the markets will not like that uncertainty.
Michelle, one of the things we heard from Jay Powell, the chairman of the Fed this week, was we still have 11 or 11 plus million people unemployed, even though we've clawed back again about half, more or less, of who was unemployed. What are you looking for? We got jobs numbers coming out at the end of next week. What are you projecting at Bank of America?
Yeah, so we're looking for 800,000 in non-farm payrolls growth, with the unemployment rate slipping a bit lower to 8.1%. So that's still, it's quite helpful. It means we are still incrementally adding jobs, but, it is a moderation, again, in the pace of job creation. So it very much, correlates to what we're seeing for GDP growth as well. Further recovery, further upside. It's just happening a little bit slower than what we had seen in the earlier stages of the recovery.
So, Saira, one of the things that I'm puzzling through is we get some good data and then we get some bad data. I mean, the housing data this week were really gangbusters on the one hand. On the other hand, we're still up over 800,000 jobless claims. So how do you sort your way through it? It seems to be sort of a haves and have-not story. Some people are doing pretty well. Some people are really not.
Yeah, I mean, in the US, since the COVID crisis started, there's really been this gap between companies that structurally accelerated, like digital, cloud companies, technology companies, low interest rates, positive for the housing markets, and even home improvement sectors, which were positive on. Also, auto companies, which have tended to do better as people have gone into using private automobiles more. And it's accelerated some of the shifts downward for areas such as retail, the consumer, which we depended on for the last economic cycle, may start to struggle a bit if we don't get the stimulus in place that we need. All of those are risks. That's why in the US, we're tending towards more safety and quality with these growth companies, technology, even companies indexed to ESG. Those would even do well too if we get a Democratic sweep. And then other areas we're looking at in the US are really cheap value areas like small caps. They're very cheap, also protected. If US and China tensions continue to increase, you can look for select small caps in areas such as gaming. So when the consumer does come back, these companies could do well because of the local economies.
Michelle, going beyond the equities issue, what about the real economy, as it were, and people? Because one of the things we heard specifically from both Secretary Mnuchin and Chair Powell this week is we need targeted stimulus because some people are doing pretty well, some people aren't. Is that possible to target the people who are really hurting?
Well, it's a whole lot easier to do with fiscal policy than it is with monetary policy. And that's why I think the Fed is so focused on this, that monetary policy is kind of a blunt instrument to deal with the unevenness of the economy, but fiscal policy can be. So how do you address that? Well, unemployment insurance, of course, was the perfect example. David, you just mentioned you have over 800,000 people who are filing for unemployment insurance, 12.5 million that are still receiving on continuing claims. It's a really large number. So to the extent that the government can support them in terms of their income, support their purchasing power, that obviously would be quite helpful, and probably be more efficient than just cutting another large stimulus check to folks that may end up just putting that money into savings. Similarly, when you look at the health of businesses, small versus large businesses have more access to capital, have greater buffers to withstand the hit to revenue. Smaller businesses don't. And hence that was why it was such a big focus within the CARES Act, the PPP program, but to do more there as well. So yeah, I do think that fiscal policy is the right tool to get a more targeted approach. And that's exactly what the economy needs right now as we get further into the healing process.
Just in a word or two, if you can, Saira, is the equity market pricing in any stimulus at this point at all?
I think that's deflated out of the market recently, and that's the good news. If you look at technicals, actually, the market's starting to look pretty attractive here.